Okay, hey traders, let's take a look at today's fun that's going on. This is really good stuff. Friday into the close, we were looking to see those bears get blown out. It was a little quicker than I like. Hold on a second. Hold on just a second. There's a 5-year-old in the bathroom and I've heard the toilet flush 4 times. Hey, what are you doing in there? Okay, we're good. It looks like no trouble. No harm, no foul. Okay, so yesterday the Bulls were able to pick up a position early morning. It was a little tough for me I was focused on something else early in the morning, and I'm still kind of bummed out about that, I know. Anyway, we didn't get a bullish sample right through here, and the market was able to pop up, take out all the bears, and we got everything we wanted. It was a beautiful thing. Today, the market opens higher. So we got the gap up on Sunday we were looking for. It had already blasted through all the stops, which I left on the chart so we can do a quick review. Remember, those stops got blasted through. Sunday opened higher, which let's take a look. Let's look at what that looked like. Right here. So Sunday opens up higher, just basically sits above the close because that's where all the stops were. And when people stop out, so markets rally up and they exit their positions with a win, markets go flat. They don't go down. Going down would imply that there was demand, and bearish demand is different than bullish demand because it has some caveats. Anyway, flat, that's the expectation. We hit all the stops, there's nobody left. The market sort of reached a little higher, basically hovered around. And then this morning we got the event we were looking for, the bearish zero test, right? These are the things we paid. This is the fight over probabilities. You got to fight for these. Now, you have to remember that tension is implying something out here in the time scale. So the big institutions are not fighting over this price, trying to break out of these levels. This isn't what they fight over. This is what you fight over. They're not worried about a moving average that went like this. This is something you fight over. What they're trying to do is say, we want to control price tomorrow. That's why tension and probabilities matter so much, is because they are the best models for the future. Nope, you can't have the cat food. You can go play with the cats. So we have to think in tomorrow. You got to stop turning around and looking at the past to figure out what's happening in the future. You got to keep your eyes on the future because that's where the big players play. Tomorrow, the end of the week, next month. That's where they're trying to gain their control. So if you're constantly looking at today or if your mentality is to look at today and to say, what happened today? This defines the trend of the market. Well, you'll always miss it because you were too early. If you're looking at right now, the current price, you're too early. You missed it. It's in the future. That's where they sit and they fight over things using options and positioning and all sorts of stuff. They're trying to take over the market in the future. Now, the only time when institutions want to take over right now is pump and dump schemes, any variation, news cycles, tweets, all sorts of things where it creates some quick, easy demand that shoves price. You know what? I forgot something. Just a second. Okay, I knew something fell off. Better. Now we can do this. Now we can do it. Okay, so those types of things. So you could sort of look at the behavior of institutions in this light. Either you're prepping for a pump and dump, which is where you fill into the market brainlessly for no reason, like an idiot, and you look like just a crazed animal. Why are you buying here? Why are you just filling orders? What the heck? Because they intend to run a news scheme or something and pop the market up and just dump. This is a pump and dump, which usually ends in ranges. Or they're going to be operating in a way to take advantage of probabilities or the future of the market, the tomorrow, next week, next month. Those are the two mentalities of traders. And they don't sit and say things like, well, what's the past look like? The only time the past matters, there's only one time. And that's if you have a position here at time -1, we'll say, because it's back in the past. And somebody is holding a position here. This is the only time it matters. It never matters under any other circumstance. I've never seen it. And I look at data like I have a problem. So when you have a position sitting here and it's positive or negative, when markets come back to that position, the reason it matters is because if the market moves through, there's a liability. And if you're a business owner, you know all about liabilities. Markets don't like to be liable to pay out to losers. Also, it will inspire behavior. Behavior is short-term. Price. Liability is long-term. The market will never be liable to pay you. So if you're a loser and they can't find a person to lose more than you, you're a liability to the market. That's what you are. So if you're trying to sell here, the market needs to find a buyer here. If you're one position, they need somebody to basically be two to pay you. You're a liability. And markets will never pay out liabilities. Don't ever expect. They're as scrupulous as an insurance company when it comes to trying to cut down on their liabilities and what they have to pay out when they have to pay out. So they're not going underwater. Behaviors are short-term, meaning, you were in a position and you decided to cover. You bought out. Those are short-term. So if you're, let's see, right, if you were holding a sell position from right here, let's say, and the price comes back down and you decided to take a break even because you're wise, the market might pop up. But this is going to be the end of the expectation. You shouldn't expect more out of them because, the market's not liable anymore. So, it's over. You just created a little bit of demand, something exciting. So you have to remember, this is the only time the past matters. It's the only time the past matters. And I know I'm going over a little theory here, but I just want to cover this because it's going to be important to understanding why the market cares about tension. Okay, so we have the past prices are important because of positions. What about moving averages? Well, moving averages are just a model of positions. That's it. That's what a moving average is. What do you think a trend is? If we go like this with a trend, this is what trends look like, right? What do you think this is? It's people filling at some rate. And it's cash, remember? So it tends to be institutions are this way, retail is this way. Retail is selling, institutions are buying, and they're buying at a particular speed. Or in other words, the cash over time. If that cash goes up too high over time, the market looks like this. It's parabolic. You reach their objectives and price comes back down. If you have cash moving at a nice steady rate, you have this. If you have cash moving too slowly, you have this. Because the cash was not swamping the market. There's really nothing else here. So when you think of a moving average, what you need to think of is this is just modeling likely positioning. And the only reason the market cares about positioning at all is because of liabilities. This is future liabilities. If you have a moving average go like this, prices are like, well, you might say, well, this looks to me like the liability is down here and the market's getting away from. So this would look like market running from liability. That's what that looks like to me. You're going to use a moving average and you say, well, moving averages work. I've been saying they didn't work. But if you're interpreting a moving average as something other than a market trying to model its own liability like an insurance policy company, then you're looking at it wrong and you're going to misinterpret it because a curve upward like this could be cash is greater than time, that rate we talked about. They're injecting cash too quickly, and it causes this pattern where that you've all seen it. It goes like this, whoop, it comes right back. It's called a channel. And what's happening is that the cash injection overwhelmed the market. It blew out the top. All the sellers got scared, and we don't have a party to pay anymore. And that liability right here shot through the roof. And the market said, whoa, 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 you just lost all your suckers. So the institutions have to cover, and it comes back to neutral. It's sensible if you just look at this as a market liability model. And this is why the future matters so much, because if you're trying to position here and the market goes like this, and you're one position and you found a sucker here, or let's make that guy the other way, seller here to cover your liability, and maybe here you got a 2-to-1, that's good enough for the market, and you go like this and they cover. Well, now we have on the negative side 0 and on the positive side 1. So either you cover or the market's going to make you the product. Or in other words, it's going to go to the other side of your position because it's liable. It's simple. Moving averages attempt to model liability, but you have to be careful because they can also capture the rate of cash injection, and you might get that backwards. Cash injection increases market cap, which increases prices, market cap per share sort of situation. So this is important because right now you might say, okay, we have a moving average that's going up. I don't need to calculate that. I can draw it freehand, tell you what a lot of moving averages probably look like. Well, actually, they probably look like this. So why are the moving averages work? Well, because we got all these guys. They're trapped in. They're paying the liability. Hi, Pierce. They're paying the liability to the downside. So, of course, markets are running up. They're running away from that liability. Institutions deal with their own liability, unlike retailers. Oh, hey. You go over there. You go on. All right. No more video. You guys don't get to see my animated face because 5-year-olds can't resist the camera. So we have our liabilities pointing down. So the curve should rise. We see them trapped in. We see the market run away. This is the way, if you think of it this way, you could say, well, the liabilities are, institutions are going to come handle that liability. They're going to match up. They do the math. They know that. Okay, so what's this all about? What's this bear bull test? And I'm going to focus more on this than walking through this situation here. We'll get to that, and this morning's. We'll get to that in a second. The first thing to say is we had our probabilities down through here on the 30-minute, and then they popped up. And look, as soon as they popped up, it went the other way. Well, that's because the bears were like, no, oh my gosh, no. We're the liability. We want to control probabilities. So if they could control those probabilities, they come in and they sell. They're just selling the probabilities. They're saying it's popping over, meaning that when this is above 0, when these are above 0, these two values, what it means is that it's easy. It's easy for bulls to control prices across the across the index or across the exchange because probabilities are in their favor. They got a better hand. They got 3 aces. But it's easy. So what the bears want to do is they want to push those probabilities back with everything they have, because if you have advantage, everything's easy. The problem they ran into is that they pushed so positive here because of the blowout into the close that shoving it back got us right to a nice 0 test. Now this is smoothed, but you can see right here, the 0 test, the first 0 test was right there. You see that? It came back, it got to 0, and the bulls said, no. They have daily tension. 30-minute went right over, and they have a huge group of suckers, losers, people who are not thinking correctly. They've done the wrong math. And those suckers can be seen here. So when it hits 0, the bulls came in and said, no, this is ours. And they're buying it up. You can see that. You see the bears injected cash. You see the bulls injecting cash. This is not a battle over today. This is a battle over Friday, the end of the week, the rest of the week. They are fighting to say who gets to be in the easy seat for the rest of the week. That's it. That's what this is about. And the bulls have daily tension. In fact, they never even got close to losing it into these lows. It wasn't even sort of a fight. It was just pathetic. The bears screwed it up. They did terribly all week last week. They didn't pull off any work that was meaningful. And yeah, sure, they got tension down, but you see this zero test here? It just correlated with the low. Does that look to you like the bulls walked away? Is that what that looks like? We have a zero test and the bulls come in and buy aggressively and never come back. And the bears get a zero test and push it back a little bit. And then the bulls never left. They stepped back for a bigger picture. They pulled it back. So that's where we are right now. Overall the analysis you can look at, the most important thing to note here is that these bulls and these bulls are essentially the same people, and they're not letting go. And these enthusiastic bears, I'll give it to that, they're enthusiastic. They were able to get a sample right here, and right off the open, did their very best to press this back. But do you see the problem? Do I have to explain it to you? These bears are massively underwater here, and these guys, you have to pay for your mistakes. You pay out. You don't get to make massive calculatory blunders. Is that a word, calculatory? So this is where we are. We have the bulls who are dominating the bears on the meta scale, the bigger, the day, this week, next week time frame. It's just true. I can see that plain as day looking at tension, and hopefully I've described it so that you can look at this and go, oh yeah, I see the bulls' responses to tension. You could see the bears' response. They got real enthusiastic a couple of times. You remember? Let's scroll back a little bit just so you could get a character, a read on their character. I don't go too far. A read on their character. You remember this day? These bears did their best. They did their very best. You see these huge spill-offs. This one wasn't really, but we had a huge spill-off here with tension and no price response. Huge spill-off here with prices. They were injecting cash just like mad and just accomplished nothing. Just nothing. So now it's time to pay for your oops. That's where we are. I don't think this is really all that tough. I mean, if you were to just look at this in terms of like a sport or something, if you saw maybe a basketball team run with all their might and burn off, I don't know, 50% of their leg energy, because, running is a big deal. You run here with all your might and burn off another, 40% of your leg energy. You got 10% left. Here's your last 10%. You ran and ran and ran and ran. You pushed your very hardest and did nothing. You scored no points, and the other team is still ahead. You're just screwed. You're out of juice. You got nothing left, and the other teams, it's easy. It's not really all that difficult. So looking at this morning, putting this whole thing into context, and you think, okay, so this is where we are. Take a look at this. Do you see this? What does this look like? This is eating up. It looks like a little bit of stair stepping, but let me tell you what this really looks like. Someone had a buy signal. Someone had a buy signal. Somebody had a buy signal. Somebody had a buy signal. Somebody buy signal. Everybody gave up. That's what this looks like to me. You could call it sort of a channel thing where, push, but I don't think that's what that was. In this context, we have buyer, 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 buyer. This is destroying the signal market. People getting signal after signal after signal from an RSI to an EMA to price action to, some sort of more advanced price action to levels, to just everything. That's what this looks like to me. It looks to me like this just chewed up stops like there is no tomorrow. And I guarantee you, if you were sitting here watching on the way down, you had at least 3 reasons to buy. At least 3 of these peaks interest you. At least 3 of them. And then by the time we got down here, it was clear that you should quit. Well, if you're looking at this. If you were watching tension right here, it was clear there was a zero test and that the bulls were going to come in and have some sort of response to defend probabilities. But if you're trying to trade any signals, I guarantee you, and the reason for that is because I know that majority of signals are based on basically momentum, which means that you're going to have a lot of signals that suddenly cross up. This kind of thing. So this morning, there's going to be a lot of crosses, a lot of confirmations, if you will, that the market is now moving upward. And so the market's chewing up those stop losses as people are unwilling to hold because they're trading signals, not what's going on. That's what this looks like to me. And it should look like that to you. And I'm going to guess if you looked over all your signals and stuff like that, you would have looked over this morning and said, oh yeah, well, I had a bunch of signals and that was some tough stuff to see so many failures in a row. I mean, if you were a failure, you'd say, well, the bull failure, I don't know, was 1, 2, 3, 4, 5, 6, I'd say 7. You would say the bulls are failing this morning, and that's a mentality a lot of people have. So you might be very bearish about this. And whether the market moves down or up, the fact that you're adding up failures doesn't, those types of things, I think this is just chewing up all the things that follow when you move prices up. Okay, so we've covered sort of the philosophy here. I wanted to get that whole thing laid out as like he's distracted but quiet. Laid out as a groundwork so that you can understand kind of the mentality I'm coming at this with when it comes to figuring out what's going on here. Okay, so let's take a look at the positioning of the day. So the first thing that happens is decay moves down, and there's our trapped orders. Nice and easy. Our bullish right off the open. Now the bulls do nothing. They just don't do much. We have the market, tension did rise a little bit here. Out of that, sure, but it comes right back to it. So at this point, you should be looking at this saying, well, that means they're going to get stopped, and you're right. But if you're cunning, you're looking at tension, saying to yourself, bears are going to want to defend this, bulls are going to want to come in here. That you should have been waiting for that. So right here, you put your stops. I'm going to say right here is where I'm going to have them. And I'm going to scoot these stops. I'm just going to scoot this line over and use this one. Ooh, that's an old one. Okay, right there. That's where I think these bulls stops are. Yeah, we'll just keep it like that. Okay. The next position isn't until here, where velocity signals that momentum's going negative right into this low. And I don't like signals that correlate right with it. But this one happened right before the low bar. We have it right there. You can track this again. Also note this signal lines up with where the stops would probably be. No, I didn't actually cherry pick that. That's just where I thought those bulls would have their stops at. I do it mentally. I don't actually draw on my charts here. And you see we have a little move down in tension, a little acceleration down through here off of that into that low. So this is where the bulls would be sitting. These two spots. We still don't have bears. We have a switchback. And the bears finally show up here. Now, why is this important? The bears showed us out of the highs that they are wanting to defend tension. You see tension moving down at this point. You see that the bears want to push this back down to zero. You should have picked up on that. And we liquidated a bullish position right here into another one, but still. So these bears show up and we get the bears pushing the market. They push tension down and they push this down. So bears, they're hitting. They're doing a great job. Okay, now at this point, remember, they're trying to get tension, 30-minute tension, back down. Why would you be motivated to do that? Well, you got a bunch of upside down positions probably lingering from last week. That results in this coming back down and sampling the bulls again. So we got a back and forth. Now, at this point, you start to think, is this getting noisy? Yeah. Here's another bullish position. It pushes up. We get a bearish position. And you see how this is starting to get kind of loud. It's like, oh my gosh, there's so many positions here, which pushes down into another bullish position. Now, when you start to get these back and forths like this, You gotta step back and go, gosh, it's a lot of samples. What is happening here? And you should have stepped back and taken, it's just a lot of back and forth right in the same area. Step back and say, are these bulls looking at something else? Are they waiting for something else? So we talked about this last week, that this is what bulls do. They'll step back and they'll say, you know what, let's just not participate in the immediate liquidity game and let's play the bigger picture. And they're waiting for tension to get to zero. And we see that because right here, when this dips down and hits zero, that was the major response. So that's kind of what happened. We got a lot of noise moving right into that. This to me looks like a lot of noise. Players up and down. Now I'm still going to track them. I'm still going to mark them out. But it was a lot of noise moving into that area there. So we can then take a look at the bears, one more under, and it pushes back up out of here. So there probably is going to be some bears sitting right here. And you can see that these guys are all sort of around the same area, really. You see that? So I think what happened was the bulls in the morning were looking at tension. They didn't have somebody on the backside. There was no sucker, no loser. So this is a tough one to run with. You don't have somebody on the backside. They wanted to defend 30-minute probabilities. We got that. We got somebody on the backside, and now the market is moving up. This is our landscape. These guys probably have their stops above this beautiful hook. Nice hook. Just smooth as calculus. So this is probably where stops are at. The bulls, I think, are here in a big way. Then there's some smaller, shadows here. Shadow bulls sitting here. Now there is a little bit of an issue. Okay, now we got through the positioning. There's not much else. Oh, wait. Hold on. Bears here. And you notice same price, again, right at the same area. And the market switches back, hits the bulls. The bulls are filling now. Okay, this is where we are. You see this? The bears are at the same price here with their stops right above here. And I have to assume the bulls, these guys anyway, their stops are going to be right down here below this main position. This is how we're all laid out. We got our bears here, bulls there. Okay, now we have a little bit of an issue. This morning, the bulls failed. They did impact tension. They did have a price response. These are the requirements. You see, there was a player there, a big player, and they got pushed out. But then we had a bigger player, and I call this getting bigger fished. The bigger player was tension. They got bigger fished out of their position. And it is something, if you're not paying attention to the metagame and the long-term players and what they want, this can eat you up. That's why I brought it up last week, that you have to remember that sometimes bulls will step back and look at tension and say, let's just wait for tension getting to zero, and then we're good to go. So that's where we are. Now, who's winning this game? What's likely to happen next? Where do we go from here? Because that's all that matters. Nothing else matters. At this point, we could see the bears have a position. Now, I'm going to mark these out on the chart so we have a little bit better idea. Their position is probably going to be about right there. The bulls now are going to have their position about here. And the bears' sell position is going to be here. Right about there. That pretty much captures everything. And I think essentially the bulls are sitting down here on this zero test. This is the one that I think matters the most. And then the first bullish position after is here. And remember, a secondary position has teeth. Please don't forget about that. Roots. This is going to be our root. I think our origin position is here off of that low. Then we have the first root. This would be probably about second root kind of thing. This is how this is organized all the way up. And it's really is amazing how the bulls have managed to somehow pick up lows and nothing else. It's amazing. They did just so great. Okay, let's clear that out. Now let's take a look at what is going to come up next. We need to model motivation. So what can the bears do to keep tension, which +2. We have a +2 upside force, which is not much. What can the bears do to pump 30-minute tension back down? Well, they need to drive this down through this root position and blast out these stops down here. If the bears can pull off that work, not a scary dip, not a terrifying news data point, none of that. They need to actually get some work done, which is getting tension to move down and blowing out an important spot in the market where the stops are going to be sitting for today. How do they get that work done? That's what they need to accomplish. How can they pull it off? Well, we've got a position here that could be used as a trap, shoving that down. The issue, again, this is the issue. This is the issue the bears are looking at. So let's say that it's the future. They got this down here. They pushed right through the stops there. 30-minute tension curled down. The very next thing they've got to face is a daily zero test. And this is one that's been in the face of the bears for days. This zero test will get picked up by bulls. They have controlled daily tension for a while. They are going to defend those probabilities. They don't want to lose them. They don't want to give them up. They don't want to have them tested. But if the bears can manage to get some work done, we could see a good daily test. That's what they need to accomplish. So if the bears are going to pull that off, remember, this isn't enough. This isn't enough. This is what they need. They need to get it all under. All under. That's what they need. That's the work that must be done for the bears to accomplish their job. If they can't pull it off, it's just short-term stuff. And that's, but everything starts short-term. So you can't assume that because it's a lot of work that they can't do it. They'll be crazy. But this is the scope of what they got to get done. So we're sitting here looking at these bulls coming in. The bulls, we're not seeing much of a response out of there. I would argue there's just nothing happened here with tension. Price never responded. The bulls didn't do much with this position. In my opinion, if I were this bull right here, and by bull, I mean I filled across 3,000 stocks, stonks. I filled across 3,000 stocks. I own at least 300 ETFs in a decent way, and I'm probably filling orders in 4 futures markets. And I'm taking all these and hedging them against an interest rate position and probably a dollar hedge, some sort of dollar future somewhere, maybe something like this. And this whole position is probably going to cost me at least $500 million minimum to be spread out all over the place like that. You just can't accomplish anything meaningful. This is a massive position. I'm the kind of person that this is the type of positioning I'm doing, and I'm sitting in these lows, meaning this is what I would call a portfolio or an institution. I don't mean the little institutions that try and shadow trade the people who know what they're doing. I mean the big ones who know what they're doing. What I would be thinking is, all right, let's just let the bears hang themselves. That's what we should just let them, see if we can get them to spin their tires. That's what you want. You want to see the bears spin their tires. One of the best plays the bulls have in their playbook is do nothing. We see this one because the bears come in so enthusiastic and then they shove things down. We see this all like right here. This is a good one. Shove things down and it just sort of sit back, let the bears have their fun, have their way with the market a little bit, and get screwed over in the long run. So the do nothing gameplay is there. We have trap them upside down, where you get the bears to come in, market comes in, bounces off the backside, and then shoots up. This is I always call it the play in and the stop gameplay. These are a couple of gameplays they have. They could just fill, but right now the ball is sort of in the bears' hands. I think this is a major root position. I definitely think with this here. So that is. So what are the bears going to do with it? It's a bears attack time. What can the bears do to get this done? Okay, so I think that's what the bulls are doing. The bulls are basically anticipating getting these stops here. That's what we've been doing for what, a week, almost 2 weeks now. If you've followed, this is the same story we always get. Well, this isn't. This is not the same as we had last week. This is a more major position because of it has to do with probabilities instead of liquidity. It's a bigger fish here. This is a bigger thing. Now, if I had an origin position from here and a root position that was so incredibly amazing that it's almost the same price, you could tolerate teeth on this position. Which is a scary prospect right now if you're trying to participate in this market. These bulls could totally tolerate some teeth on this move here, and we could see the bears get a little bit of move down here before the bulls pick up they shake off any weaker hands. That's important to remember. Teeth, 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 teeth. Just constantly be thinking about teeth, because that is what clarifies a lot of the price set. Because if you think about this whole thing, right here we had an origin, and this was really close to the origin. So this amount of time and this amount of time, the rest of the time you need to consider teeth. So I would say 90% of the time you need to be thinking about teeth. Now, they don't happen intraday, intraday you can have a major position run and then you get a position that has teeth on it. So there's moments where you don't have to consider it if it's the lowest position in the day or something along those lines. But teeth, teeth, teeth. Everything makes a lot more sense if you're thinking about teeth. And to make sure you know what a tooth is where you have a root position. So I call it a root position that you can play from. But if you're rich and you want to sound credible and respectable, you might say operate from. A root position to operate from, and the market leans back and gives you a secondary, somewhere to increase your position size. You sit back, let it pressure that, look for the stop out, and then take up your secondary, and that is a tooth. You bite, you shake the smaller hands, and that's how you operate from. If it's pressuring your root position, you are not operating because you're losing. They're not losing, so you can operate from a nice low position and wait for the stop outs and be a little get your positioning that way. Okay, so they have their root here. Now, what do we need to see these bears? And now I'm focused on the bears first because this is their play time. They're given the opportunity here to try and get this down. That's why I focus on bears first. If this were a bearish market, I would focus on the bulls first, because sequence matters here. You need information about bears before you need information about bulls in this, because bulls, this is really all you need to know. That's what they have to accomplish. Pushing that down, blow out that position, this secondary, pressure the root. That's what they would need to get done. We could see tension potentially curl down and get some work done. We've seen this story before, this particular story, not this one. This story before. The bears run an algorithm, they do whatever damage they can, and it just doesn't work. But this is a little different. These guys here, they have something called advantage. They've got 30-minute down, and they have this position here. So I would probably wager that all the bears that you know are this funny little thing called motivated. Okay, let me restate that. If you know any institutional bears, if you know any price action chasers, or any signal chasing bears, they should be just utterly demoralized. So, and the way you can detect if a trader is demoralized, are you ready? I'm going to tell you the secrets of interacting with bears on Twitter. Demoralization is an internal process. What does that mean? Well, if you think of, this is a person, here's their shoes, and let's say here's their pants, got arms, okay? Demoralization happens inside the person, and the person internal. It's internal. I say that. It's just, they want to keep it internal. You don't want to let anyone know you're demoralized, ever. If demoralization ekes out of you, demoralization radiating out of you is akin to having money radiating out of you. You don't want people just taking your valuables, because demoralized traders are the easiest ones to screw over. You want to hide your demoralization. So you mask it. You mask it in a nice veil of something called confidence. But it's fake. And it's the methinks you protest too much whole thing. So demoralized traders are very confident. So if you try to interact with a signal chasing bear right now and you question them, you'll probably get blocked. They'll block you. They'll block you. That's how you know they're demoralized, because they won't engage you because they're so confident that they've gone liberal. They've turned into a hardcore liberal. Or that they're, I am so right, I can't even talk to you. I'm offended that you would even try to talk to me. You know, the liberal attitude. They're so offended, they'll block you for saying, hey, your position is not working out or something. You get blocked. Or they get very quiet. You're like, hey, I know you're over there. I know you're doing stuff. You see my message. Why aren't you talking? They're demoralized. So they'll try to, really, it's the shield, you know? Their typical behavior, if you can gauge that, they're what they call the base behavior. And base is a relative term. It is not, it means it's their typical over time. So if you know how they behave over time, this is how you detect demoralization. Either they get really excessive and start blocking people, or they get quiet. And the last behavior, which is my favorite, is the new tools. And these new tools betray the old tools. This is my favorite one. So you find a trader who's been using a set of tools for a long time, and then suddenly they just betray all their old tools and they don't care about them anymore. They're garbage, and they're finding new shiny tools that they have discovered that are so good. And the new tools strategy it happens a lot to people who, yeah, you can watch YouTube. You didn't, yeah, you're good there. So the new tools one is one that you see a lot too, where it's like, well, you know, I've been using this one signal for 5 years and I know it works pretty well, but since I got betrayed by it, they scribble all over it and they say, I found a new tool. So these are the three things that I look for. It's pretty clear. One side gets demoralized, that's how it works out. So at this point, because the bears have an okay position here, you know, it's not underwater, and because they actually, you know, were able to get tension back under zero, well, the bears are probably motivated. And you can't have, are you ready? Here's an identity. If this were trigonometry. Like a trig identity. So we'll write it like a trig. The participants, let's see, retail. The retail's E is going to be for emotion, equals basically the inverse of the institutional emotion or feeling of the market. It's just how it works. So if the institutions are motivated, guarantee the retail is demoralized. They're just, this is the identity. It's just how it works. It's the way that the machine is designed. It's brilliant, just absolutely brilliant. Okay, so that's where we are. Go out, look at your Twitter accounts, find your favorite perma-bears. Go ahead and take a look at their demoralization. Are they blocking people? Are they excessively quiet? Do they have new shiny tools that make them right because they're so wrong, you know, kind of thing? And hey, you could get a real-time sample and come back here and let us know. You're like, oh yeah, of the 5 people I looked at, 4 were one of those things. It's fun because it's so reliable, that people are so reliable there. Okay, so what we have had, now that we had fun talking about, for me, that's just fun. Let's take a look at what happened. We had the volume here that we were tracking get more volume, or really this looks a lot like teeth to me, and finish up here. So our bull position came in, we had some teeth. This would be the spot for a secondary. Now is when the bears want to run. We're seeing this, the little algo to try and pressure the legitimate participant. So if you're sitting here saying, Logan, you're bullish. Well, when do I buy? When do I buy? That's up to you. I'm telling you what's going on. I can tell you where the bulls are. When do you buy? Well, here's the bulls. Here's some teeth. Here are the bears trying to shake these bulls out of the market. Here's VoltiWap. This is you need to figure out how to participate. What you should do, and maybe this is an instruction I should focus on more, and this is my overall objective for you. I say, here is the condition. And if I tell you the condition's going to look like this, can you find some tool? Can you open up this and scroll through here and find some tool to take advantage of that? Yeah, you can. Of course you can. The thing that those tools don't tell you is the condition. None of them. I've gone through them all. None of them. So the condition here, I could say, here's what your expectation is. Or if I said, well, your condition's going to look like this, that's the expectation. Can you find tools to risk management, find some positioning, something, model the things that challenge these. If I'm telling you this is what's going on and this is what the bears are going to do, go get some tools that challenge that proposition. Find some tools that look for that kind of thing, and try and take advantage of this under the context that this is all its expectation. That's what you should do. I'm not trying to give you signals. I'm trying to say, here's what we're looking at, here's where we're headed, here's why we're headed there, here's what the market should look like, here's, you could probably infer volatility off of a lot of this, and then you can go out and find tools that'll take advantage of those conditions and what they look like and how you want to deal with it. But you really need to have your own system of entry. This is like, and I've had a lot of talks with people, this is the difference between, here's a guy who's got a walking stick and he's blind. So he has glasses on to hide his blind eyes because he doesn't. And here's a guy who's not. Okay. And here's the street. We're going to do some forced perspective with this street. Because all the terrible forced perspective. And here's the idea. This is the concept. If you can see, you can cross the street. And what a lot of people do is they'll say, oh, well, you just got lucky. I'd say, no. When you can see, crossing the street is not a feat. It is not an amazing, wonderful achievement. Successfully crossing a street is not that cool. But if you're blind, crossing the street is a gamble. You have to run and hope you don't get hit by a car. And this is a busy street. So my goal isn't to say, here's when to buy, here, let me tell you what to do, sheep. Oh my goodness, no. It's to say, here's what's going on so that you could sort of get an idea about where the cars are and stuff like that. And then you could cross the street successfully. And a lot of other people are going to say, well, that's just happenstance. We can't measure that. Sorry. And it's like, well, being able to see doesn't mean it tells you to cross a street. It doesn't tell you when to cross a street. It doesn't tell you a lot of stuff. But if you have never seen before, of course you don't understand vision. Of course you don't. Of course you don't. So this is I know it's a crazy philosophy way to put that, but my goal is to say, look, you can see where everybody is. Now we know the bears want to run algorithms, and oh my goodness, are you surprised that that algorithm didn't work? Is this insane? Am I accomplishing that? I really hope I'm accomplishing that. My goal, you can see. Go get your tools, and then you cross the street how you like to cross the dang street. So this is how this works. The goal is vision, not you're not blind. I think that people are intelligent. I think that you can totally pull this off. So that's the objective. I have lots of time in here to talk about these fun philosophical things because we know what the Bears need to do. We know what they're gonna do. They ran it algo, didn't work. You've seen this before. If you watched this stream last week, doesn't this look familiar to you? The Bulls are in a position, the Bears are in a position, the Bears are really not getting a whole lot of opportunity down the road. They run an algo, the algo doesn't work. Have you heard this story before? This is literally how every single day last week ended. Every single day last week ended. There is a difference because this low is created off of this instead of off of liquidity, and this is the main function of the low, where last week and pretty much the week before, majority of the lows were built out a little bit differently, but it's still the same story. Okay, so this is where we are. There's not really much else to say for the Bears. They have a big ol' huge amount of work to get done here on the downside. I mean, if you want to know how bulls work, you really should just rewatch the PM, the one into the close, every video from last week, and you'll be like, oh, I see how bulls structure markets because they did the same thing every single day. And they're doing it again today. And then just figure out how that sort of pattern works together, and then you have a really good model for how bulls operate in markets. It's like, boom, there it is. A little bit of work and you can figure it out. Or just keep modeling these out. Eventually the behavioral sort of pattern will become pretty clear. Now, what's interesting to me is that while the outcome is the same, the way we get into that outcome is not the same. It doesn't happen the same way. So what it is we have a more theory. Are you ready? A chaos market where the initial condition, which is the one that chaos cares about, you can only calculate chaos if you know the initial condition. And in this particular brand of chaos, the initial condition is variable. It's a moving target. And I would say it's difficult. It's not just a variable, it's very difficult. So while the outcome is essentially the same thing every time, so if you say, well, I know the initial conditions, therefore I know the outcome, okay, fair enough, but your initial conditions are a moving target. They move both through time, through organization, through methodology, through structure. They are a very multi-dimensional variable, probably over 4 or 5 dimensions. And so what ends up happening is the outcome is easy to understand, but the ingress is not. And that's why I think it takes a person. You have to understand the variables and how it's all structured. You have to know people, and then you can calculate your outcome. So it's a chaotic market with a very, very, very versatile initial condition, which you can define if you take the time, and then you can understand how the chaos is sort of going to work out. So it's not really chaos, but it sure looks like it. All right, so there's not much more really to be done here in terms of analysis. We could see this, get a little noisy again. I think basically what needs to happen here is this bearish position is probably going to need to turn upside down. The market's going to sit on the back side of it. It'll take all day like usual into the close over the next 45 minutes. That's what the bulls would like to see. What the bears still want to see, they want to see this move down to here. That's their goal. Can they get it done? Do they have the prospect? I actually think with the origin down here, root here, that teeth, I'm okay with. This doesn't bother me even a little. Not even a little bit. The problem with that is that if you're sitting here thinking to yourself, oh, well, then that means that the bears can push this down through the lows. It's like, well, the bulls wouldn't have an issue with that. And not having an issue with something doesn't mean it's bearish. It just means that, the bulls won't have an issue with it. I think fundamentally the best position, the golden the holy grail position is to own a contract long here and to wait for that to first be profitable and then convert that initial position into a put, a long put against it. Yes? What do you want? We got you some toast. You want some cereal? Oh, wait, no. We drank all the milk yesterday. Drank all the milk. We go through milk like crazy. Once you're in this position where you have a put and it's what it is, the strike. Hey, be nice. Be nice. Why you gotta be so bossy? Why you gotta be so bossy? The strike minus the premium and this value, you strike minus, is above your root position. You have no risk and nothing but profits. This is the holy grail of positioning. You cannot position better than that. And then you're allowed to wait through teeth because you don't care. As long as we get the outcome you're looking for, you're good. So that's the best position you can be in. First, you get your root, you wait till it's profitable, then you hedge it. Well, what would you like?
Crackers with what cream on them?
You mean cream cheese?
Yes.
Yeah. I got him into saltines with cream cheese on them, which was a little snack my mom used to make when I was younger. It is the antithesis of health. It's fats and carbs mashed together, but it's delicious. And then sprinkle some spices on top. It's delicious. All right, I'm going to get him some food. I think you could kind of see how this is going. I'll be back in a minute. Yeah. There we go. So not much happened here. We're sitting here right about the backside of that little position we were tracking from earlier. The market's staying there. You could look at this as this bearish position being favorable, but I don't think that's really the best way to look at that. So if overall you're examining the things that I've said, you should come to the conclusion that your risk for the downside, at least intraday today, is higher. You have a higher risk than we have seen in the past. So previously I've come up with these statements where my statement is, I think this is going to run to their stops. I still think that's true, but in this instance, because of the positioning of the overall market, because we're in essentially a tertiary position right here.
Hey, Daddy.
Oh, you turn them in. Here, let me see that. Maybe you got, here we go. See, this is what I made it. The little, see, just stick cream cheese on there. Delicious. It's delicious. Anyway, because this is a tertiary position here, the market can tolerate. Oh, you need one more cracker. He likes tournament sandwich, so one more cracker. Okay. The market can tolerate a little bit more downside because of the tertiary position. We could see some teeth on this one. So your risk is higher to the downside. So I'm obviously going to be promoting a little bit more of a focus on insurance today, that you need to essentially be bullish with the concept of insurance in the back of your mind because of this tooth concept that is a reliable concept. That's where we are. These guys down here, which I would say you could just mark these, maybe that, I don't know if this would be an effective algorithm, but under this context, you could just mark these out and say, here's the price, these prices here are essentially where the bears are stuck at. So everything kind of down here in this range, this is where all of our bears, they've filled orders through this area. Okay, so that's where their positions are, and a majority of them will be in the lower half because typically people, as much as they like to say they sell high, buy low, they tend to sell low and buy high. It's just the natural tendency of people. So they're probably going to be down in this area here, right? Like, so we see this dip here, probably below that dip is where most of the bears are going to be sitting in big losing positions. And, coming to that conclusion just using where the tension is under zero. And the reason this is an effective way to think about this, remember, is not because tension is a magical line. It's because tension is modeling all the stocks. There's probably people in all sorts of stocks. I don't know. You probably have a bunch. I could probably list off a bunch of stock symbols, and we could go through them carefully and see that you have some version of lower prices, and now the market is at some version of a little bit higher prices, and they're sort of underwater across the index. And that's going to be the way that this works. So you could go through all the stocks and look at that, and it would be a further clarification of where the positioning is and things like that. And that would be one way to do this. But this just sort of generalizes that model so that we can see it here. That's why I'm using tension to take a look at the trap. So let's get a little bit further into the future. Let's say that the bears run an algorithm and they actually, for once, get some work done into the close. Let's say they do that. Let's consider this. Price will go like this. I know it's okay. Let's keep it. Price will go like that into the close, and we probably wouldn't have a whole lot of time. It could bounce back up, but we're just not going to consider that. Tension would come down a little bit here. Probably we'd close it like best case plus 4%, but probably plus 3. We'll do best case. you know, +4. We would blow out this position and potentially anyone holding on these prior positions through here. So a good chunk of bulls would get knocked out. Not the largest bulls, but institutions nonetheless, big players. Market would probably close like this. I think immediately the price would probably bounce back up at least halfway, at least. But, you know, we'll just do this. Okay, at this point, let's now consider going through tomorrow. What would tomorrow look like? Well, we demoralized a bunch of the bulls. So the bulls are going to want to not play as much. What the bears will have to do right off the open tomorrow is trap in some bulls and then drive the market down. So they would get, I'm going to guess tension would open flat. I think it would open maybe right around there. Now, the first issue that the bears are going to do it, sorry, my stepdaughter's calling. She's calling. I'll give her a call back in about a half hour. The very first step that needs to happen, by the way, if you have an Apple Watch, this is the best ever. Let me know. If you have an Apple Watch, that's like seriously the best way to like silence a call. The best, probably the only, if you need one reason to buy an Apple Watch, that's what it is. You just go like that with your hand and it's done. Anyway, okay, so 4% is not that much. It's just not great. The bulls could come in with and quickly turn 4% over. So this is not an attractive prospect. Do you remember this one right here? We get this down. You see this short dotted line? This is 10%. And it's essentially halfway to the most that we ever see, which is on the daily chart. It's really for the daily. Daily gets to about 20%, but that fluctuates, but that's about it. So this is about half, it's 10%. So you can use it. You see this was what, like 13%? And that's really not that great. You know, 70% is what we see as psycho extreme. Plenty of room down, not amazing here. 4%? Come on. That's just not that much. So at best, okay, at best, the bears could push this down and get nothing. That's just not great. It's just not that great. That's not that great of a prospect. I don't want to be offered the opportunity to leverage all of my resources just to get a little meager gain when there is much more motivation to drive things higher for the bulls on a major time frame. So it's just not a really good prospect. It's just not a really good prospect for the bears to have. If they could get this down just 10%, at least then there's not this blinding reality that the market could actually open in one bar above again. I mean, we saw that here. Just look at how fast tension can move. It can open above. That is a terrifying prospect for the bears if they decide to jam this down and try and get some work done. They could literally be putting their foot into a bear trap. It's not a great prospect. And that's important because if you're trying to control the future probabilities and the gameplay here basically says, go ahead and try and call the bulls bluff, do it. By the way, they're not bluffing. I mean, I wouldn't do it. If this was a card game and I was the bears, I'd be like, that's not amazing. But that's longer term. That's over the next day or so. The bears themselves have the opportunity for basically a little elasticity, which elasticity is where the counterparty that's just the worst handwriting ever. Elasticity is where the dominant party, dominant or controlling party, and this has to be evidential, not theoretical. You can't say, well, I think the bears are in charge now. Well, tension's over zero. The daily tension's over zero. The bulls have been successful over the past couple weeks. I would not call today the bears are all of a sudden in control. So the dominant or controlling party, evidentially, where that you can point to allow the counterparty to run price more favorable. So remember, this is the dominant party want favorable prices. So the dominant party could say, hey, bears, you can drive this down because that's better for us. We can pick up better some contracts down there. We can get advantage. So we'll let you drive it down by getting out of your way. And you could easily read into this here and say, hey, these bears did nothing. Right? They did nothing. And that could be considered a nod. But this doesn't follow all the rules for a nod. This is something else. Remember, a nod is where we're trying to drive elasticity down to zero. This is under zero. So this is an issue for this philosophy. It's not a nod. Elasticity is, it could fall under elasticity, meaning maybe the bulls are saying, hey, drive this down. We would like to buy in a new low. And then they pick it up tomorrow. So that would make it elastic. It's like, it's like a string that's sort of not taut anymore, and the bulls, you pull on it, and the bulls are like, we can't get it to shoot. So they let the bears drive it down so it's nice and taut, and then they grab it, and it, boop, pops up. You can shoot. That's why I call it elastic. At least that's what I imagined in my head. So I wouldn't call this a nod, nor would I really call this a nod here, because it looks to me like the bulls impacted tension out of that, so not a nod. So that's elastic. So we could view this as a bit of elastic to integrate those teeth. And we can see that the bulls are not doing much here. The downside probability is much higher than we've seen in the last couple of days, because the bears have position. They've got a position upside down. They have a stop loss target, and they've seen the bulls not do anything after a root position was formed. So we've got a lot of options here for the bears to be able to pull this up, but it's very short term. That's going into tomorrow. So the bears might say, well, we can take what we can get, drive this down, close us here, get a little bit of fun tomorrow, but they're going to be facing daily tension still not down. 30-minute tension is not that far away. I mean, so you could sort of get the landscape. Near term, bears are probably a little more motivated than usual. And we've talked about they're motivated. Longer term, they're still not opportunity like they want. But all long-term trades start in short-term markets. You cannot have a bear market that doesn't start with a single tick. And it goes from there. So in this instance, if the bears did, let's say this was the start of a bear market, which I'm not saying that. It doesn't look like, oh my gosh, the bears came in and they had everything they wanted. It looks like, well, we got a little bit of probability. What can the bears do with it? And then the bears going to do what they can. And, if they fail, it was just a pullback. But please appreciate the fact that I'm still bullish on the market, but the bears have a little bit better probability to the downside than they've had in the past week or two or three. And maybe they'll jump on that. Maybe they'll just say, well, let's just go for it because we don't have anything else. Because we haven't seen anything good so long. Maybe they'll jump on it. We'll get an algorithm down into the close and it'll be so terrible. And we could see the bears give it their best try. But in the long term, I think what would happen is they would pressure this low. And by the end of it, however long this time frame is, I don't know, it would just look like teeth. It would look like a nice toothy market, which would look like elasticity in real time. So we'll see. We're going to get to see this. I'm still bullish overall, but I'm leaning down. I'm leaning bearish. Just because the probabilities, the way this is all organized here, the way that they've got it set up. What else have the bears got? They haven't had anything. Okay, we're getting the decay. You see, decay finally made its way all the way back from down here up to zero. and we're getting this shown up. I'm gonna, well, I'm gonna leave these here because if these bears do come in, this could be useful data from here where we see the bulls and the bears. We can see where they're positioned at and stuff like that. So we'll just leave these here. I'm not sure that this one's gonna be all that useful. This is the root off of the previous day where that it all started. So I'm gonna leave that one there. So I'm a little bit more bearish today than I have been in the past, but I'm still overall on bullish. The possibility to move down is here, but I think overall that would just generate teeth, and we would end up. And this is why I think the golden position is you own a long and you have a put that's hedged, where that if it just expires you make money and it has upside potential. I think that's just the best position you can have because you can tolerate things like teeth and stuff. All that would matter to you is that you don't see a conflict where that we have an issue between the two parties, or that one party is actually defeating the other party. That's not good. Okay, let's take a look at some other charts really quick here. I want to take a look at this chart. You have to remember with these expansion variables, if you're using this thing, that these things update essentially, they're a pattern type thing. So you have to just understand that. They look for patterns, and pattern doesn't consider time. It can update, it can do whatever it wants. And it could go however. Anyway, this is the target for that pattern, which we actually have a previous point of control, which marks out this is where that expansion bar wants to get to. And you could look at this and say, well, I had it marking out here a little bit earlier, but the data updates and this is just what happens. I still think the expansion target's here. The issue with these types of targets is that they don't tell you when, they tell you where. So if you're like, well, it says expansion, it has a target, I'm just gonna buy. Well, you messed up. It doesn't tell you when. You thought it said when. It didn't say when. It says where. You still got to come up with when. And you can't be mad if it does this. You thought it said when. It didn't say when. It said where. So this is outside of respective signaling. It shows targeting. But nonetheless, this is the target. We can see that there. It's all set in place. Our backfilling. We don't have the backfilling, which is a metric that helps you know if it's going to move around or not. Once the backfilling's over, it'll set in place and you're good. But looking at this, look at this interesting. Is that interesting? It's like, and to me, this looks like more volume at lower prices. That's what this screams to me. It says the lower the prices go, the more volume there is. And this is, if anything, a temptation to the market because markets are run on commissions. They just love those commissions. So this is saying more prices at lower, more volume at lower prices, and markets say really more. If we drive it down lower, we get more free commissions. And I calculated the commissions once, and I said if there was, I think it was like 20 cents. If they made 20 cents per transaction, which is per tick, which is a difficult thing to calculate because Thinkorswim does not allow you to look at ticks for some reason. You can't call the function tick count on a daily chart for no good reason. So it took a little doing. But calculating across the board, if we said 20 cents, or no, actually I did a penny. It was a penny a tick. It was like billions a day in commissions running through. Now, because of Robinhood, that's dramatically gotten cut down because now the philosophy is zero all commissions, which I think is the right way to go. I honestly think that if you're not willing to pay commissions and you just want to, take your $100 and stick it into a stock or something, and you don't want to pay commissions or support the system in any way, I think you should be order flow. I think you should be. The problem then comes if all trades are order flow. I mean, if Robinhood created this standard that says that every broker should do this, it's extra money. And the reason it becomes a standard is because then Robinhood has extra money, where maybe if you're going through, I don't know, just say TradeStation, let's say they don't sell order flow. They have less. Well, that means on the playground, Robinhood has extra money. So then TradeStation says, well, we need extra money. We have to compete with these guys. So then they sell the order flow. Well, then there becomes a problem, because then they're selling order flow and commissions, which means that they have more money. And so the pressure comes back on Robinhood, and Robinhood says, well, we can't charge these commissions. So you get this real sort of betrayal. And if traders don't move out of their commission-based brokerages, those commission-based brokerages have a massive advantage. And they can pressure and squash those who don't charge commissions. Or if people leave, then we go to a no commission. And I totally agree. If you're not going to pay commissions, I think you should be. Order flow, you should be. You should expect that the market knows what you're doing. You should. So I don't have a problem with that. If you want to not be order flow, or essentially not get screwed over by the market, there's a lot of work to do. It's a lot of work. I think that's fair. I'm reading the comment on Twitter, and I'm going to try and pronounce your name. Adisha. I'm going with Adisha. Final answer. Yes, they're still valid. They are valid as long as they are what I call open. So, oh, you guys were over here. Yeah, I will call this open. It's open because we haven't gotten to that level. So it will remain open until it's tested. The reason that I track them is because the propensity is the market doesn't really like them. We scroll back. Here's another one. Markets don't tend to like open expansion targets, and they tend to work like an expansion bar target. So it'll continue up until it's closed, where it gets tested. And let's see, this is right here. It closed. So this one pretty quickly, almost immediately. The point is that these expansion targets, and this one wasn't very large, and it was likely expanding here, retested it, expanded again, tested it. It probably did it a time or two. So it's just the market tends to like to close those expansion bars. It does not mean that they will close immediately. You don't always get that kind of luck. So I like to look at the context first. And then when you're trying to figure out what the next, like where are you headed next, I'll pull this chart up and say, okay, well, if the bulls are going to, or the bears or whatever, this will be the context. So in this context, I'm actually a little bearish about this. Overall, I'm bullish. Long term, I'm bullish. But right here, because of the way I think the bears just don't have anything else. I think they're going to try to get this down to here. Right? I think they're. So maybe put this old expansion bar target on the back burner, and wait until we get this all cleared up and we're back to where the bears are underwater and the bulls have a position and say, well, I know whether they're going to want to go first. Another thing that you need to pay attention to and is this right here and this right here and this right here. While that, yes, there's nodes, there's also, more importantly, I think, low volume nodes. Markets don't like no volume nodes because there's no orders there, which means there's no transactional profits. So markets tend not to like to hang out where there's no orders. That's why the point of control is such an appealing feature. Well, obviously, it's appealing. That's where the market wants to go to find the orders. But something you can't see with the point of control. You ready? I'm going to tell you a secret about volume profile. If there is no volume here, the market's not going to want to be there. It's going to treat this no volume like a low volume node, and it's going to leave and go hunt volume somewhere else. So you can't see that because it looks like you'll make this connection. You'll say there's lots of volume here because of the point of control, and you're wrong. You're not completely wrong. You're right. There are a lot of orders here, and the thing that makes this useful is that it implies open interest increased That's the implication. Well, it's not, it changed. And the reason that's important is because if open interest increases, that also increases market cap, which increases share price. So if it increases, you'll see it move it up. If it decreases, you see it move down. And so people say, well, if there's a point of control and if there's a lot of volume, then the open interest obviously changed the most there. But that only implies it. You can't actually see that in real time since open interest is reported in a bunch of different times. So we could see open interest increase here. We could see it decrease. We don't really know. But we do know that the market likes it here because there's a bunch of orders, and that means money, 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 commissions. So markets go where the orders are. That's where they go. That's what they like. That's how they act. So if those orders dry up, you can't see that in the point of control. The volume could just totally disappear, and the market goes, hey, there's nothing here. Let's go somewhere else. And so it could suddenly move up to here or up to here. This just sort of implies that there tends to be more volume here and there. And the market stays away from LVNs, or it'll sit right here and fill until that LVN is suddenly not an LVN. But it'll bounce off of them. You see, it'll come up, it'll hit those low volume nodes, it'll stay, or it'll break right through them. So I would call this a pivot. A pivot is a non-directional thing. It says, all you know for sure is that a pivot markets don't like to stay there. So that we're going to head out. So mostly I just think of volume profile. If you just want a general rule of thumb to think of, just think of commissions. And just say, hey, there's commissions here, none here. So of course markets bounce off of low volume nodes. Commissions here. So of course, if we head up and there's no volume, it's going to go back because it wants the commissions. The market is looking for money to pay out to the owners of the market. For instance, the ES. Who owns the ES? Do you know what corporation owns the ES contracts? Because this corporation is the one who designed the market mechanics to pay them. Big corporations do things because of money, not ethics, not opportunities, not to help the little guy. They built an ES contract and they sell that as a product because it's super profitable. So you say to yourself, well, you could talk about market makers. You could talk about those. Market makers would be partially employed by the corporation who owns it. Nonetheless, the corporation is going to, these are going to be MBA type people too. They're not going to be real thinkers. They're going to be stinkers. They're going to say, we got a bottom line and we need to pump that bottom line. How do we get that bottom line? And that's it. It's all commission based. I don't think their main source of income is selling data feeds. I think their main source of income is transactional. The ability to profit off transactions and stuff like that. And they sell the thing. And the reason that you would buy the ES is because, have you ever looked at how difficult it is to create a security that can get traded on the world exchange? Oh my gosh. Oh my gosh. There are a ton of rules and more paperwork, I think, than a person could do. You have to have like a team of people to get it. It's a big chore. So it's sort of, the entry price to create a security is extremely high. And when you eliminate, competition due to literally anything, when you eliminate competition, we have a term for this in economics. You know what it is? It's called a monopoly. And monopolies are no good because they tend to struggle with regulation. Too big to regulate is the problem with monopolies. It doesn't, and the other one is innovation ends. So if you have a monopoly, they stop creating new things because that's not, it costs money to do R&D. It costs money to try new stuff. And MBAs don't care about new and helping the planet do awesome stuff like Elon Musk. What they care about is the bottom line, and they will push and push and push. And if you're not aware of this, all corporations or all business is essentially a push towards slavery. Is it sad? Yeah, it's kind of sad. But it's not a business's job to be ethical. It's a business's job to make money. And so you're essentially, all businesses should be pushing towards slavery. They should be saying, I want to treat my people however I want to treat them. I don't want to pay them because I'm trying to make money. And it is society's job to push back and say no. So the businesses don't go towards slavery because either people quit and society stops, or there's regulation. This is just the truth. So what happens is regulation helps this pushback. You can enslave people. So businesses don't. If we didn't have regulation, they would. They would, because it's profitable, because it's the right choice. It's not a business's job to make ethical choices. It's a business's job to round up cash. That's it. So regulation and society, the innovation stifles as well. So this is one problem. And it's also, I think, the reason that major exchanges are stuck in the 70s. We're looking at line charts. Why are we looking at line charts? This is like ancient technology. It's because it's a monopoly. You're insane if you believe it. We look at boring, obsolete data set models. Do you have any idea how cool data can look? It can be like three-dimensional. We can do it in VR. We can make it pretty, but we're stifled because securities is a monopoly. This is a big old monopoly. It is king. And they decide. And they collect taxes or, excuse me, fees in order to play. If you want to play, you have to pay. And that's how it works. So you need to keep that in mind. And when I look at this chart, that's all I think about is, where are the commissions? Where's the money? How do we milk it? Where do we not go? Where do we go? What was fast, slow? All that kind of stuff. So yeah, maybe that was more than you wanted. All right, let's take a quick look at the options world, the SPX regulars. Remember, this is just the regulars. It's not the weeklies. It's not the quarterlies. It's just the regulars. And there are only 13 in sequential months. So if you pull up your options, you may see 13 different things trading. It is only 13 months out. So if it's what is it, wow, I stare at charts way too much. It's February. So this goes to next March. So here's March. We could have one every month, and then it could skip a month because there's no volume. And then no volume. And in this instance, there would only be, because I'm calculating 13 of them minus 2, 11. So if you see one that's like the expiration is December 2023, that is not calculated here. Anyway, so one of the things we want to look for is positive spreads. The puts tend to occur down here. The calls tend to occur up here. So you can see that we had, look at all this call. This is the darker the red, the bigger the volume. It's 1,000 or higher. You see there's a good chunk of calls up here, and I'm going to guess they were short calls, trying to collect premium. A good chunk of puts right here around the same time. Maybe people are long puts, short calls. Is that fair? Does that kind of look what's going on here? It looks like what's going on to me. These calls, if we had a dip in price here and then came up, I would assume these were a hedge. But because price was still making its way down, had not created a low yet, this to me looks like these are not a hedge. So this isn't a hedge. It's not the thing that we typically look at for like a hedge. This is something else. Also, we have a couple of orders out there. Short out of the money positions don't interest me as much for intraday analysis. That's a little bit longer term stuff because of the way they work. But I'm more interested in this kind of thing, which is a huge premium, where this one is just this little tiny premium. So these are not equal. This one is bigger. This 1,000 is bigger than this 1,000. This interests me. This interests me. That's interesting to me. Call right here, call right here. So you interpret that how you want. Looking at this, I think the most interesting one is this, probably this call here, because of the way the morning was with the 30-minute zero test we had right at the open. This call looks like it might correlate with that. This here doesn't look like it's hedging out any short position that was profitable unless you shorted here, but I didn't really see any institutional shorting there. So no. I don't think we have a real great handle on anyone in a great position right now. So look at these bears. I'm sorry, bears. What's this? A push, a push, a push, a push. What is this, the morning again? Who is doing this? Who on earth thinks that just stair-stepping it is just the way to do this? Just chop, 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 chop. Tension, got a little move down. Bears, you suck. Look, they didn't get the work done. They didn't get the work done. They failed again. Yay, bears, good job. Tension runs. This shows you there was an impact. We had a bearish position here and some other stuff. Bulls trapped in, they're trying to shove it down. At best, these bulls probably liquidated some of their position into the close, just saying, oh, we don't want to hold on it. But they didn't get all the way down. They didn't pressure anyone. Good job, bears. You dumped a bunch of cash into the market. And as usual, you failed to accomplish the work you needed to get done to have any advantage. Their best option with 4 minutes left, I don't know, maybe they run an algorithm into the close, maybe. Not even 4. We're going to round down. I round down. So we got 3 minutes left. I don't think so. I think we just go like this and close here, right on the back side of that position, because. So I was rooting. I'm gonna say right through here, rooting a little bit bearish. But because they couldn't get their work done and the market's about to close, perhaps they do it after the close, I don't know. But this looks to me like the bears couldn't pull off what they wanted to pull off. Because if they'd have gotten it down to here, we'd have gotten tension a little bit lower. That would have given them the best advantage at +4, but couldn't pull that off. And it would have wiped out and demoralized some of the bulls, which could have led to a little bit more tomorrow. But they did their favorite thing, which was inject capital into a market, spin your tires, and fail to get your work done. This is not what bears need right now. They don't need this right now. What they needed was to get some work done. So bears fail to get work done. Under decent, I'd say it was decent conditions. That's the way I'm viewing this. The bears failed to get their work done. So now this is saying to me that it looks like now what the market's going to want to do is take a look at, because the market's going to close and they didn't pull it off. And you really got to wipe out these players, because think about a lot of these people, a lot of retailers or shadow traders, a lot of them are going to dump right into the close. So they're not going to be able to push them out and cause tension. So at the close, we'll see those people dump. We'll see the market, basically rebalance as they do that. And then these bears are going to be stuck as a liability. Essentially, this position here is going to look like a liability to the market. It's going to go, oh, you lost all the people that you had convinced to hold into a position. You look a little like a liability. And what the liability means that directionally, if price moves down, cash goes in to there, right? That's why it's liability. Who's going to pay for that? Markets aren't going to pay for that. So the bears could come in and inject a bunch of capital, which would look like this. They pay the cash to deal with that cycle. And that could be an advantageous way to do this but it just doesn't. I'm sorry, it just doesn't look bearish anymore to me. I was given a little bit of bearishness there. I was a little bit on the bear side. I was a little bit going, hey, I think this is going down. But seeing how much effort the bears put into it, I think it's more likely we sort of hang out around here. Unless they run their little algo right here into the close, maybe they could do something. That's not a good algo. This is not a... This isn't what a bear algo looks like, by the way. This is what a bear algo looks like. Well, this is two of them. Or... yeah, that's about it. Oh, here, this is a bear algo right there. That's what they look like, not this. So I think the bears just messed it up. I think they had chances and opportunities and things were looking real good, and all they could do was just choppy. They just chop. So going into tomorrow, this is going to get real good. So listen up. Tomorrow, we have what I would consider mild effort. That's great. Mild effort means there's participants and you're going to pay for your mistakes. We have tension, did not get that far away. It was a little bit of a move down, but nothing amazing. The bears did have a little effort there. So tomorrow, the very first question that's going to be happening in the market, the very first question, can the bears do it then? Maybe they didn't want to do it today. They do it then. Okay, so the first thing you need to look for first is that I don't consider trapped people from today to be relevant tomorrow. So the first thing that you need to do, this is for bears, is trap bulls. If they can pull this off, maybe they'll continue this mentality tomorrow. If they could trap in some bulls and then two, and these don't have a particular order, they just both need to happen, is find a bear position. Okay, this has to happen. If this happens, the bears could potentially, right in the open, run something down. And the third thing to remember is their focus is daily tension, okay? So if you see this happen, and this could be in the first 30 minutes, so I'm talking about it now. If this happens, the bears' goal some point tomorrow or the next day would be to get 30-minute tension down. We didn't wipe out the bears into the close. The bears did something, and the bulls seemed okay-ish with it. We have the mentality of teeth, which could definitely still on the table. I just think they did less. So if we get that all to set up, remember, the bears' focus is this, down to zero. This is all they get if they pull that off, okay? If the market pops up, let's say we have tension here. That's going to look like a gap up to right here. That's what that would look like. Same deal on the other side. If the bulls decide they want to pop tension back over zero, the first thing we need, and remember, this is the first 30 minutes of the day is probably when this will happen. The bulls are going to need to get a position to impact tension. That's 30-minute over zero. Okay, so the bull's objective will not be daily tension. The bull's objective are these stops here. So if they come in with a bullish position tomorrow, we could see it lean down, grab up a nice buy, and their goal will just simply be to make those bears pay at that level. I know I don't consider this tomorrow, but if the stops are open, I'll leave them there, and that's going to be the objective. This will be what the bulls want. That's going to be getting 30-minute tension will look like this. It'll go over zero, and then it'll probably just lean up throughout the day, most likely. So these are the two game plays. They will play out. Nice. Right off the open. 30 minutes. You got about 30 minutes to an hour to see this stuff happen. I think it's going to be quick. I think you're going to have to really be on the ball about it and keep your brain on. Make sure you're paying attention to the way things lay out and stuff. Don't just say, oh, there's this. You know, you still need to pay attention to markets and stuff. So that's going to be the gameplay tomorrow morning. It'll be interesting tomorrow. I anticipate overnight, best case scenario, we see price move down. Best case. Otherwise, I think the bulls will probably, if the bulls are going to, we'll probably just see something like this. They just hang out, not really go anywhere. The bears could get enthusiastic and try to capture those teeth overnight. Maybe they have to. I don't know. So I would not be long overnight tonight because bears still could drive this down. They didn't get any work done into the close, which I'm just like, gosh, you guys are the worst. Okay, sure. So that's where we are. Tomorrow, I'm still bullish about this overall long-term multi-day. I still think the bulls have everything. They're in control. But intraday bears still, you know, they did get you work done. They failed. So we'll see tomorrow. We're going to need to see this tomorrow. All right, guys, I will be back tomorrow. Yes, somebody said, any idea how Globex session might work out right now? Yeah, I think that it's more likely if price moves, you know, directionally, it's more likely to move down and pressure the lows. If the bears don't want to inject that capital to do that, and they'd like to just reset and maybe get a better position tomorrow, then it's, you know, I don't think the bulls are going to be shooting this up overnight. Not like we saw that. I think most likely that price just hangs out in a range that's probably under or right in this, under that position there. Probably just hang out in here, and then we continue this narrative tomorrow, and this is going to play out over tomorrow. We're going to see this story tomorrow. It's not over. Bears still have that option to capture the longer term teeth. That's a push down and pressure in these lows. There's no reason the bulls don't have to worry about that at all. So if it's going to move, it's going to move down. But I think it's more likely that we sit sideways. I wouldn't be trying to buy into this for a shot higher overnight. I don't think we're going to be seeing this tonight. If that happens, it's going to be tomorrow after the bulls get what they need, and they'll be driving things up to get over the top of this little curl that we had. So do with that what you will. I'm not a person who really is big into being bearish, but I think the bears have a little bit of a case, or at least it's building. We'll see tomorrow. All right, I'll be back and walk through this tomorrow. Good luck, guys.